Welcome back once again. This is Catherine Morgan-Nance. In our final capital budgeting video, we will discuss how to evaluate a project using the simple rate of return method. The simple rate of return method is also known as the accounting rate of return or the unadjusted rate of return. It is similar to the ROI, the return on investment calculation you learned in a prior lesson. The simple rate of return is another screening method that does not involve the time value of money and discounted cash flows. Rather, it focuses on accounting-based net operating income. Furthermore, it differs from the payback method in that it does not focus on cash flows, and therefore non-cash charges such as depreciation are not added back to net operating income. To compute a project's simple rate of return, divide annual incremental net operating income by the amount of the project's initial investment. If any equipment is sold or traded in at the beginning of the project, its salvage value reduces the initial investment. We'll now consider a simple example. Assume the management of the Daily Grind wants to install an espresso bar in its restaurant. The cost of that espresso bar is $140,000 and it has a 10-year life. The espresso bar will generate incremental revenues of $100,000 and incremental expenses of $65,000 including depreciation. What is the simple rate of return on this project? Pause the video for a moment to see if you can determine the solution before proceeding. The simple rate of return divides the annual net operating income of $35,000 by the initial investment required of $140,000. The simple rate of return for the project is 25%. Notice that the simple rate of return calculation yields a percentage of the initial investment. The payback period, on the other hand, yields a number of years it takes to pay back the investment. Criticisms of the simple rate of return include the following. First, it does not consider the time value of money, and second, the simple rate of return fluctuates from year to year when used to evaluate projects that do not have constant annual incremental revenues and expenses. The same project may appear desirable in some years and undesirable in others. As we've discussed previously, the simple rate of return and ROI calculations are very similar. We have learned that our decisions as a manager are influenced by the manner in which we are evaluated and compensated. When investment center managers are evaluated using return on investment, ROI, a project's simple rate of return may motivate them to bypass investment opportunities that earn positive net present values. Finally, one of the most important functions of management is to evaluate historical results in order to improve future performance. Often the company's internal audit department will be asked to perform a project post-audit. A post-audit is a follow-up after a project has been completed to see whether or not expected results were actually realized. The data used in a post-audit analysis should be actual observed data rather than estimated data. A post-audit ensures managers who have responsibility for investing are accurate and thorough in their pre-investment analysis of project costs and benefits. Thanks for watching. This concludes the Capital Budgeting video series. We covered a lot of useful topics, including the time value of money and the net present value method. Please feel free to contact me if you have any questions about employing these concepts. See you soon.